Have you ever been watching the market? You see this perfect level and you think, okay, this is it. Only to watch price smash right through it, take out your stop, and then, just like that, reverse and go the way you thought it would? It feels totally random, right? Almost like it's rigged. Well, what if I told you that move wasn't random at all? In fact, what if it's one of the most predictable things the market does?
It all comes down to understanding one core concept: liquidity. And I promise you, by the end of this, you're going to stop seeing all that random noise and start seeing exactly what the market is trying to do.
Just look at this chart. You see these clean, equal highs? Textbook resistance, right? And then, bam, price blasts through them for a second and immediately reverses. That spike, that wasn't an accident. That was a precision-engineered move, and it happens over and over, every single day.
All right, so let's dive in. To really get what's happening in those moves, we have to get super clear on what liquidity really is, not from a textbook, but from an institutional point of view.
You've probably heard this word liquidity thrown around 100 times, but what does it actually mean for us as traders? It's not some kind of mystical force. Nope, it's something very specific, very tangible, and best of all, very predictable.
So at its very core, liquidity is just a big pile of orders waiting at a specific price. I mean, think about it. Where does every trading book on the planet tell you to put your stop loss? Right above a recent high if you're going short, or right below a recent low if you're long. Well, all those stop losses, they create these massive, predictable pools of orders.
And here's the big mindset shift. You have to stop thinking of those orders as just your personal safety net. You need to start seeing them for what they really are to the market. They're fuel. They're giant pools of energy just waiting to be tapped.
Because without that fuel, the really big players, the institutions, they simply can't get their massive positions filled. And if they can't get in, price can't make any significant moves. These pools of orders are literally what makes the entire market engine run.
Okay, so this market fuel comes in two main types, and knowing the difference between them is the key to figuring out where price is heading next. We're talking about buy-side and sell-side liquidity.
It's actually super simple. Buy-side liquidity, or BSL, is that pool of buy stops that builds up above old highs, from all the people who are shorting the market. And sell-side liquidity, SSL, is just the opposite. It's the pool of sell stops sitting right below old lows, placed by all the traders who are long.
And here's what it looks like on a real chart. You see how the algorithm creates these nice, clean highs and lows? It's basically inviting people to place their stops there. These areas become literal magnets for price. The market's main job becomes moving from one of these pools to the next.
And this right here is where you get that big aha moment. Why does price seem to always hunt these levels before it makes its real move? Well, the answer comes down to a huge problem that only the big institutions have.
See, you and I, we can click buy or sell and get our order filled in a split second. But imagine you're a hedge fund trying to buy $1 billion worth of something. You can't just click a button. The second you do, the size of your own order would send the price flying against you before you're even halfway filled. It's a massive problem for them.
So think about it from their perspective. To get that giant buy order filled, they need to find an equally giant number of people willing to sell, all at the exact same price. Where in the world can they find that much selling pressure just sitting there, ready to go? They find them in those sell-side liquidity pools we just talked about. The algorithm will purposefully push the price down to break a clean low. The moment it does, it triggers thousands of retail stop-loss orders. Every single one of those stops is a market sell order, which provides the perfect other side for the institution's giant buy order. They literally manufacture the sellers they need.
And this is the absolute key. Those sell orders from all the retail traders getting stopped out, that becomes the very fuel that lets the smart money get into the market and power the real move up.
Now, I know when you first hear this, it's so easy to think, the market is just rigged against me. But it's so important that you reframe that thought if you actually want to use this to your advantage.
So instead of feeling like a victim in a rigged game, you need to start seeing it like an informed analyst. This isn't about cheating you, it's about engineering. The market is just a mechanism, and it's designed to handle massive orders. This is how it has to work.
Look, the way price is delivered these days is run by algorithms. Their number one job is to seek out liquidity so that these big institutional orders can get filled. It's not personal, it's just mechanical. And the great thing is, because it's a machine, it's predictable. Okay,
Understanding the why is step 1. Step 2 is learning how to avoid the common traps that, frankly, 90% of traders fall right into because they don't see this bigger picture.
The biggest mistake, by far, is trying to trade before the liquidity has actually been swept. People will sell right at a perfect double top or buy at a perfect double bottom, and they put their stop in the most obvious place possible. By doing that, you literally become the fuel. Another huge mistake is thinking every high and low is a target. You have to have context. You have to ask, where is the market trying to go on the daily or the weekly chart? That's your higher time frame draw on liquidity.
All right, so we know what liquidity is, why it's targeted, and what mistakes to avoid. Now for the fun part. How do we actually use this to our advantage? Let's build a simple, powerful framework. First, you got to figure out the higher time frame draw. Look at a daily or weekly chart and figure out where the market is ultimately reaching for. Second, and this is the hard part, be patient. Wait for price to actually take out a key liquidity pool. Don't do anything until then. Third, look for confirmation. After that sweep, you want to see a strong, powerful shift in direction, what we call displacement. That's the algorithm showing you its hand. And only then, fourth, do you start hunting for a precise entry that's in line with this new direction.
So if you remember just one thing from all of this, let it be this. Liquidity pools are targets. They are the destination. They are not the entry signal. Your trading will get so much clearer when you stop trying to guess the exact turning point, and instead, you wait for the market to hit its target first.
This framework gives you the where and the when. You can now start to anticipate the market's next big objective. But that leaves us with the million-dollar question. Once that liquidity sweep happens and you see the shift in structure, how do you find a really good low-risk entry to actually get in on the move?
Well, that is where another key concept called a fair value gap comes in. It's basically the footprint the algorithm leaves behind after making one of those powerful moves. In our very next explainer, we're going to break down exactly what those are and how you can use them to find a high probability entry. So make sure you subscribe so you don't miss that final piece of the puzzle.